Welcome back to the Scholar Wealth Podcast. This week, 2 listener questions involving opportunities that look compelling on paper but need a deeper look before deciding whether they really fit. We'll start with a question about commercial solar investments that promise large tax write-offs and how to think about those deals beyond the tax benefits. Then we'll work through a listener question about franchising, where the projected returns look strong but a meaningful amount of capital is at risk, and what to consider before treating franchising as a passive investment opportunity. To close, we'll step back with our quarterly Scholar Big Picture with Dr. Deon Strickland and talk about what's changed in the economy and how it shapes decision-making right now. Let's go ahead and get started. Our first question: I've seen some heavy tax write-offs by investing in commercial solar installations. Can you help advise me if this is a good idea? Whenever we look at any type of investment segment, especially on one fund or one typical project, what we want to look at is the investment itself and whether or not that made sense. A question like this would be akin to asking, what do you think about me investing in restaurants? Like, well, that's a big thing, right? There's a lot of different considerations taken into account. When we get into the solar investments or some of these properties that have a lot of tax incentives, that typically leads the conversation. We start to hear things like you could have negative returns in the first few years because of either credits or depreciation amounts. Usually in something like this would be a lot of depreciation amounts where there's going to be a lot of capital costs up front for these solar installations, a lot of equipment that's being purchased, a lot of property. And based on that, huge accelerated depreciation write-offs early on. We're seeing this, especially now, over the past few years, there's been a lot of incentives toward accelerated depreciation. And this is where you even kind of outside of solar, Section 179 expenses and everything, where you could write off a significant investment early. And that's done by the government to incentivize investment. That if I'm going to go install something that normally I'd have to depreciate over 10 to 20 years, that's very different than me being able to take all 20 years of that expense and depreciating it all up front, because that's going to mean I take this huge loss up front on paper. And because I take that huge loss up front on paper, that could be used to offset gains in other investments as well. So I save more on tax up front than saving the tax over the next 20 years. And kind of pure time value of money, I'd rather be saving money now as opposed to you telling me I could save money 20 years from now. So that helps to generate the benefit in these situations. But what we have to do is step back and say, that's great, right? The tax benefits are absolutely wonderful. But if we didn't have the tax benefits in here, does the investment make sense? And that's what always worries me about a lot of these different types of energy investments. And it's not just solar. Solar's having its own difficulties right now because we're seeing a lot of pullbacks on some of these types of credits and incentives from the government to invest in solar. So because of that, that makes it a little bit risky, but it's not just a solar situation. We see this with oil wells as well, where somebody says, I'm going to go invest in oil wells because there's a lot of government incentives to invest in oil. And I'm going to go buy 5 different oil wells or invest in 5 different oil wells down in Texas. And that's going to help generate some losses up front, especially from a depreciation perspective, and all these credits for oil and gas investments that can help my investment. I always go back, and what worries me as an investor is I look at that and say, if my investment is solely reliant upon me taking depreciation and credits, then that's not much of an investment for me, because eventually those depreciation and credits go away. Most of the time they're front loaded anyways. Depreciation is a great example. If I could take a bunch of depreciation my first year, 2 years of investing, that's wonderful. I'm going to generate a bunch of losses that I can use to write off on my taxes to offset some of the gains. But what happens in years 4 and 5? When those write-offs are done? Am I losing money now every single year? What's the liquidity in this? Can I get out? What's the timeline? What is their exit plan in these scenarios? And what you end up finding a lot of times in these is that once you get past those tax benefits, and I'm saying this in general, right? This is not specific to any individual investment, but once you get past that initial benefit time period of where all these tax benefits reside, then the investment doesn't look as good anymore. And I'm not saying it has to be taking losses, but maybe your return's only 3% or 5%. And you say, well, now you're stuck making 3 or 5% in something that's not liquid and has an indefinite time horizon. That's where the problem is. So I would encourage you, as you're looking at these investments, to not look at it as, I'm looking at this only from a tax perspective, but look at it as, I understand why the tax incentives exist. I understand what they're on. Now, can this business be sustainable without any tax benefits? And if the answer is yes, then the question is that investment an investment worth doing in years 5 to 10 as opposed to years 1 to 5? Because with the lack of liquidity in these, you're in it. You're in this game for a while. So those first 5 years may be great. And sometimes we get these blinders on and we keep looking at those projections and they show you a 3 to 5 year pro forma and everything's looking great. And they're showing you comparisons of how much losses you're going to be able to generate, what that's going to save you in taxes. And then conveniently 5 to 10 is is not there. And sometimes they'll come back if you question around, they'll say, well, that's too far in the future for us to estimate, so we don't do that. Yeah, you got to watch that type of situation because, of course, that's far in the future, but that is also convenient if all the tax benefits are done by year 4 and year 6 through 10 are actual losses and you're not earning anything on your investment. So keep all that in mind. It's not that solar doesn't make sense in general when you're looking at these types of investments, and it doesn't mean that investments with large tax savings are a bad idea. We see this all the time. There's great opportunities in energy, there's great opportunities in real estate to be able to do this. I would just encourage you to look beyond the tax benefits and say, is this a business that I want to invest in? And on to our second question. I've been approached about investing in a 7 brew franchise. The upfront investment is around 2.1 million for a 5 store commitment, which would represent roughly 20% of my invested assets. The projected returns look strong, but I'm new to franchising. What should I be thinking about to determine whether franchising makes sense as a passive investment? So these things are popping up everywhere. These 7 brew investments, we're starting to see a lot more of this. I've seen it on the triple net side of people buying the actual buildings. But the actual franchise ownership, it's pretty common that we see franchises, especially smaller franchises, in buckets. In other words, they'll come in as a region. 7 Brew says, we want to take over Winston-Salem, North Carolina. And what we're going to do for that is we want to open up 5 different locations. Instead of having 5 different operators in there, they come in and get one operator to come in and run 5 locations. This makes a ton of sense from a franchising perspective because you significantly reduce the human capital risk and the capital risk associated with running these types of franchises. You're dealing with maybe 5 to 10 employees for each of these locations, maybe more. A lot of part-time employees and maybe not the highest reliability upon showing up to work and everything else, and a lot of turnover in these jobs. So if that's the case, having one store would be an absolute nightmare because you would have to overstaff. You'd have to go from 5 to 10 positions to 10 to 15 positions just to have backup, or else you're going to be in there blending up frappuccinos and pouring coffees. And that's not ideal. That's very far from passive. So the brands know that. They know, the franchise companies know that that's going to be risky and that's going to cause these different franchises to fail. But if you could go in with 5 locations and you need 5 to 10 people at each of these locations, well, now you could go hire 50 people. And if someone doesn't show up at store 1, you can move someone from store 4 over there. And you could do a little rotation around. You could do training collectively. Maintenance is done collectively. You're buying in bulk. You're buying coffee cups, not just for one store, but you're buying a truck full that you're delivering to all the stores. Which brings me to the comment about passive investment. This is by no means a passive investment, especially if you've never gone into the franchise world before. Where you see a lot of success with franchising is typically on the operator side, which sounds like 7 Brew is trying to set you up with, in the sense of they're looking at this saying, what would make you as an investor, a franchisee, most successful? Scale actually makes you a little bit more successful. Owning a whole region so that somebody's on a different part of town and they go stop at your 7 Brew, and whichever one they stop by, it's yours. So you would own that region. But the real benefit is they want you to have a home office. You're going to have one main operating center that you use to run all 5 different locations. And that's where deliveries might be coming in. That's where you're running HR. That's where you're running payroll for the 50 to 60 people. And they'll likely have some support in these areas, but this is anything but passive. Where this really becomes passive is like any other business becoming passive. And what I mean by that is it can become passive if you run these 5 and you hire a few really good managers and you have one true operator that's running all 5 franchises for you. And they're the ones running HR. They're the ones fielding the phone calls that the coffee machine at store 3 is down. They're the ones handling those types of situations. If you don't have someone in that key role, then guess who's getting the phone call that the ice machine doesn't work at store 7. And that's going to be you getting that phone call and you having to drive over there or coordinate with the maintenance person to go deal with all of that. So I'm really hesitant to call this passive, especially without the experience in franchising. If you told me you had a ton of experience, and Stephan, I've been running franchises for years and I already own 5 Subways and a few McDonald's, and you have all of this in your portfolio, and now you want to throw a few 7 brews in the mix, then you've already cracked the code. You likely already have operators that you can move around into these different areas. That's why you see these different franchises typically are run. I mean, we've even seen it scaled to like private equity status where you'll come in and you'll have one fund open up where you come in and you run this region. You've got 5, 7 brews and you're killing it. You've got a great system in place. So what do? Now you've stepped back. You've got a great operator there. You've got great employees. You have a great setup. The next move is you go look around and say, you know what? This city over here doesn't have any 7 brews. So now I'm going to go invest another 2 million and I'm going to own that region as well. So now you own 10. And now you're very much removed. Now you might hire your own maintenance person that is maintaining all 10 properties and they're just cruising around in a vehicle that you own and you become a management company for this exact franchise. And then maybe you open up another 10, another 15, and you have a large fund that's running all these. That has its own risks. That is one option, but your risk now is you better hope everyone really likes 7 brew because that's your only option. And that the franchise fees don't ever get high enough where it hurts you and that side of things, especially on the personal investment. So that's one angle that we take at it. The other is, does it make sense for you to go put 20% of your invested assets into this as a passive investment? If this is in your mind just a piece of the portfolio and you've got a job you're running somewhere else, then I would say no. I wouldn't go drop 20% of your invested assets into 5 different franchises when you have something else on your mind that you're focused on from another job. If you said, Stephan, I'm good with, sounds like about $10 million that you have in the portfolio. I've got $10 million in the portfolio. You've looked at it from a big picture perspective. You've gone in and looked at how much you can invest in something. Maybe you're thinking about retirement or making a shift from your current job and say, I've always wanted to run 5, 7 brews. So this is my dream. This is my passion for it. I'm going to quit my job. I've got my $10 million portfolio. I'm going to take 2 million, go invest in these 7 brews. I'm going to have $8 million left and I'm going to create this as my business. Then I'd be okay with it. I don't think that would be crazy to take 20% at that point because it's a different type of investment. Now you're investing from a business perspective and you're concentrating, but as long as that 8 million still is able to sustain what goals you've set for the future, then I don't see any issue with you pulling 20% off and putting that in the investment if that's going to be your focus. The risk there isn't necessarily the investment itself as much as it is the risk of you not having the time to make sure that that investment is successful. And that's what you're balancing right now. And that goes back to circling back to the beginning of, I wouldn't look at this as a passive investment opportunity. I would be looking at this as, do I want to get into the coffee business? And if so, is this a good option? And if both of those are yes, then let's talk about what percentage of your investments you're throwing in there and how much a percentage of your time and human capital is going into you running this 7 brew empire that you're creating. All right. So to close out today's episode, it's time for our quarterly Scholar Big Picture conversation. We're joined by Dr. Deon Strickland, financial advisor and our in-house economist here at Scholar Advising and a finance professor at Wake Forest University. We'll zoom out from the headlines, talk through market behavior, broader market trends, especially on the economic side, and what we're watching right now and why. So I think the biggest thing I'd want to know is when you're looking right now at the markets and taking that zoom out situation, what are the things that are concerning you? What are you watching right now besides just the overall market moving up and down?
Well, I think the thing that concerns me more than anything else is uncertainty, right? We don't know what inflation targets really are. The fight that's really occurring, and it is become a fight, right? Before it was a little snipey, and now there's a fight between the administration and the Fed. I don't think I could have ever predicted that a Fed chair would drop a video or comment on a Sunday night saying, I'm being pressured to change rates. I don't want to change rates. And there's a criminal prosecution as a result. That's really unusual. I think we all know that the thing that investors hate more than anything else is uncertainty. If you can tell me that rates are going to run hot, rates are going to run cold, inflation, if you can tell me those things, investors can rationally adjust their portfolios and their expectations. They move their anchors. But when there's uncertainty, they don't know where to move their anchor. So I think the biggest threat to what has otherwise been an amazingly resilient economy is growing uncertainty.
Do you think we see the rates drop over the next year? And if so, what's the problem with that? We run it hot.
I think that is true in the sense that if you go back and you look, right, the Fed has historically, say for the last decade at least, had this notion of a 2% inflation target. And if you go back and look, and I did, it's not clear where that 2% comes from, right? It's not a tablet was delivered on high. That's not where we got this 2% number from. So I'm not sure it really matters whether we run at 2% or 2.5%. As long as we believe that is a long run cycle. We believe that's going to be consistent. And I thought the Fed had moved off to 2%. I think there was a lot of discussion from the Treasury Secretary to economists throughout the economic community. And they're like, well, maybe we're going to see 2.5 or 3%. And so that would mean that we're going to just see higher risk-free yields or yields on treasuries and that we're willing to accept 3%. But I saw Austin Goolsbee, the president of the Chicago Fed, give an interview this morning, and he was still stuck on 2%, really stuck on 2%. And he was conditioning any 2026 cuts on movement towards that 2% rate. Now, I'm not sure that view of the world is
It's not consistent with what we're seeing.
Yeah, it's not consistent with what we're seeing. I don't know if it's consistent across the FMOC, right? I don't think we know that. I'm not sure he would have gone out by himself and said that unless there was some number of members of that committee who are really still anchored a little bit to that 2% number. But I don't think it really matters. It just means run it at 2%, run it at 2.5, run it at 3. I'm not
Which
sure
I think is
care.
super interesting. The 2% comes out of nowhere. We've just always targeted. Now, I do think there's a benefit of having a target, because if you don't have a target, then there's nothing to shoot for. So I think even Besson has come out and said that. It's like, let's get back to the 2% first. So that way we can at least say that we can get to where we need to be. And then we can talk about there being a range. But if that's the end goal, and let's say we hit 2% here in the next 6 months, and then we move to a range, what's the difference between that and then just saying we're in a range now of 2 to 3%? And
I agree with you. I
Yeah.
agree with you. But I don't think that's going to make politicians happy right now. If you're going to run it, let's say run it hot at 3%, then you're going to consistently see 10-year yields are going to run higher that's run during the ZIRP era.
Yep.
And so that means mortgage rates are going to be stuck at 6, and everybody would prefer mortgage rates to run a little cooler than that. And I don't see that
Which doesn't make
happening.
any sense, though. Historical means are 6%. Everyone's anchored to 2% mortgages, and everyone forgets that 6% would be relatively normal.
I agree with that, but I think it's pretty easy for me to sit here and go, oh, that 6% is pretty normal when my mortgage is at 2.5, right?
Yeah.
I'm like, oh yeah, that's okay.
Yeah.
If everybody else gets hurt, but I'm okay, that's one way to view the world. But I think people anchored on lower mortgage rates as well.
Yeah.
So you can say we ran it. My first mortgage was at 7.5 or 8%. I don't remember which one it was. I didn't regard that as enormously disturbing. But if you told people that mortgage rates were going to be stuck at between 6 and 7% for the next decade, you'd have a lot of discussion of affordability and the like. I think running it hot is a short-term phenomenon in the sense, oh, that would be great.
Yep.
And then when they see the repercussions for that, I'm not sure in the long run. I don't think it would matter.
Yep.
But I think the American public has still not recovered from the price hikes we saw in 23
from the higher
inflation, right? I mean, I think they've looked at that and they still remember what it was like to go to the store and pay $2 for an item in the grocery store. And now that that item's at $2.75, they're still unhappy about that.
And it's never going down.
And
right?
it's
that's still
No.
the funniest misconception, I think, of inflation, right? People are like, I can't wait for inflation to come down so that way the prices come back down again. Now, that's not how it works. That just means it's going to stay at 275 for longer.
That's exactly right.
That's the hope. If we back up a little bit, because we're jumping into this idea of like running it hot and everything, what does that mean? What would be the implications? When we say running it hot, we're talking about you have inflation that's still a little high, maybe high in the range, and then we drop rates even with higher inflation. Because running it hot would not be necessarily just keeping inflation at, say, 2.5 or 3.
That's right. That's right.
Unless we drop the rates. We drop the rates and we drop the rates with inflation at close to 3%. Now you run a situation where everyone has prices that are going up. Capital is cheaper. So then you would hope that people jump into investments at a heavier rate, spend a little bit more. Is that the idea of running hot? And then what is the bull bear case of those scenarios?
All right, let's go back to cutting rates, right? So you're talking about cutting rates. The Fed has cut rates, 3 times? They've cut 75 basis points off rates. And if you look at the 10-year has traded in terms of yield in a very narrow band now for a protracted period of time, right? So they can cut rates and it doesn't really affect the 10-year, at least so far. But I think historically you would say if you cut the Fed funds rate or you cut the short end of the curve below inflation, then you're running negative real rates, at least on the short end of the curve. And that is really running it hot.
Because it makes no sense to invest in anything on the short end of the curve.
Right. No, you're never going to do that.
You're losing money by
You're
investing in
losing
money
money.
markets. You're losing money by investing in
That's
anything
right.
short. You have to go invest in equities.
And equity. And so if demand for equities, if we see the demand for bonds shift to greater demand for equities, while this makes me nervous to say that, I don't like to talk about demand in the context of driving prices on equities. Historically, negative rates are associated with a hot equity market, right? I mean, if you go back and you look, a lot of people, by people, I mean market participants, economists, believe that one byproduct of the ZIRP era, right? So zero interest rate period era is a hot equity market. Right. There's a lot of people who believe
But Bernanke
that
came out and said buy equities.
Right.
That was a famous
But that
line.
even predates that, right?
Yeah.
That even goes back beyond that. So there's a long notion that if you run rates too low, then you're going to get what was his term? Irrational exuberance.
Yeah.
Right. Isn't that what go back?
Yeah.
That goes
was
back
around
to
that
him.
whole time.
Right. That goes back but that's not even Bernanke. That's the previous Fed chair. I think that's the previous Fed chair who's talked about irrational exuberance. So if they do that, maybe we'll have a little irrational exuberance over the next year. But after hearing the talk this morning, I'm not convinced they're going to run it hot. I'm not convinced without substantive change at the Fed that we're going to see them push rates down below 3% in the next 6 months at least. I mean, you'd have to see 2 or 3 cuts in the next 6 months. And I can't conceive of that now.
Yeah.
I don't believe we're going to see that.
Do you think it's possible for us to hit GDP above 5 if we don't have rates cut that low?
I've been thinking about that a lot. And I think there's 2 issues with that. Let's say you badly want a 5.5% inflation, GDP print, right?
Yep.
Most people would say, well, then what's the inflation rate going to be, right? And then, so if you're going to say, well, we think we can hold inflation at, say, 2.5 to 2.75% and print GDP growth at 5.5%, the only way you get that is with real productivity growth. And there's a lot of talk about productivity growth for AI. And I went back and took a little gander. And I think the problem with attributing lots of productivity growth to AI, now I happen to be one of those people who I'm a sort of a fanboy for AI in the sense that I really do believe it's a substantive and real technology that's going to have long run productivity gains in some sectors of the economy. But I don't think the use case has been made perfectly yet, in the sense that I don't think we can attribute substantive yield productivity gains yet, right? I mean, I use it a lot.
Yeah.
You use it a lot, but like across a broader spectrum of the economy, I think it's going to take a little bit longer to see those gains. And so the only way I think you can run the economy hot and keep inflation low is these real productivity gains. And I don't know where they're going to come from.
Do you think that you could juice the productivity gains with better jobs numbers? Because we're seeing net immigration now at almost zero.
That's true.
So then
I mean,
if wages go up because of that, then does that lead to
it might lead to greater inflation, right?
That's what I'm saying. Yeah.
Yeah.
Does that naturally lead to the heat in the market?
But then what everybody really wants, what the administration wants, and what a lot of market participants want is a 5.5% GDP growth number with a 2.5% inflation growth number. If we actually get that, then yeah, I don't know how a person could not want to be long equities at that point, right? But I think if you told me that GDP was going to be 5.5%, 6%, then I would then change my inflation prediction to have a 3 in front of it, not a 2 in front of it, right? And that I think is the difference.
Which sounds good. If you're bullish on the markets, this sounds great. But there's a subset of people listening to this who are freaking out with you talking about inflation at 3% and questionable, like what the beyond 1 year scenario is. And we've seen that this year, gold's through the roof. You have silver going nuts past few days. What does that look like? For how can those two be combined? Are those two differing opinions where we have the bull case for equities? The economy is going to run hot. There's no issue. And then you also have a group that are saying, where if we run that hot, what goes up must come down. It's going to cause rates, long-term rates to go up because that leads to, we're not fixing the debt issues. We're not handling any of those concerns. Or are those completely, I guess,
I think they're different fears.
That's what I'm getting to. Yeah,
I think they're different fears, right? I think the goal, I mean, if you go find your average gold bug today and you ask them, why do they think gold is a good investment? Why has gold run up in 2025? I think a lot of them are going to talk a lot more about not trusting the overall stability of the system. In other words, like a debasement trade, right?
Yep.
So we're running, I think the last number I saw, we're running GDP deficit numbers of like 6%. And that over the long run is a pretty scary number for somebody who believes that running running huge deficits invariably leads to weakness in the US dollar. That's one person who would say, oh, gold, that's what we should buy. I'm not sure that precious metals investor today is really necessarily thinking about the Treasury Secretary saying we're going to run it hot. Right. I think
which is interesting because that would be a good.
That would be there.
That would be a rational option.
Yeah, but I don't think that's what they're thinking about. I don't think the average gold investor is really thinking about that. You can figure that out a little bit, right? It'd be really interesting now to go back and ask when we get these inflation prints, what are we seeing in terms of gold pricing? And I don't know that I recall there being that correlation there that shows me that's what.
Which would make sense. Over the past year, inflation has come down.
Right.
We've seen it become at least more stable on inflation, or at least directionally in the right direction. Yeah, gold's going up.
Gold went up.
So to your point, we're seeing more of the debasement trade as opposed to gold being used as an inflation hedge.
You're right. I don't think.
But then that's even more risky for the gold buy because now you're betting on an actual move for a debasement perspective, as opposed to holding gold in the portfolio for a long-term hedge against inflation.
I agree with that, except I would say that I am really, really, really convinced that if you said to me, Deon, the federal government is going to get the deficit under control, we're going to get leadership and they're going to fix the deficit, I'm going to take the other side, the under on that trade every day. Because there is just, I can't conceive that we're going to see that get fixed, because I think I heard somebody in the administration basically say that in order to fix the deficit, to get at this gold bug debasement trade thing, then really both political parties in Washington have to jump off a cliff. Right? They can't.
Yeah, absolutely. Taxes have to go up and time has to go down.
Yeah, right. And there's just no way any one party is going to do that. It would take the reincarnation of George Washington. And I find that to be an unlikely result.
So we have a mixed portfolio then of equities and gold to handle. Is that
that would be right. So some gold-backed bonds, right? Maybe get some, it doesn't exist anymore.
Those are gone.
Those are gone. But that would be a really cool buy right now. If you could find some for me, I would buy them. Some gold-backed bonds and
equities.
and equities would be a really
Take
nifty
the juiced
trade to
equities
take.
and
Yeah.
the protection for the long term on the.
That's right. That's right. That's right. That would make sense to me if you believe that's what's
Yeah.
driving metals, right? And I don't know that's true. I just don't see, given that 10-year has come down so much over the past 12 to 18 months.
Yeah.
But while it's coming down, gold's going the other direction. That
Yeah,
doesn't make
it's-
a ton of sense to me, at least at first blush.
Because you'd expect that if gold was going up, people were worried about the
Inflation.
debasement, inflation, and everything else, and then you would also see that reflected in the 10-year rates going up because people would require higher return for the higher risk of
That's
U.S.
right.
government.
That's right.
Right?
And you're
That's
not
it.
seeing that in general treasuries, nor are you seeing that in tips as well.
So this is another angle to take on that one. If you look at gold, gone up significantly throughout the year, rational or not that decision is made, silver has not gone up by that same amount. So do you buy silver with the expectation that it should move up in the same direction?
I would not. I mean, if you ask the person who's like doing this debasement trade, I'm not sure they view silver as the same hedge that you see with gold. You use the words, not me, of non-rational. I think either one of those is potentially non-rational, right? But I'm not going to get in the way, right?
Yeah.
I think you would have to be really, really brave to try to get in the way of a silver or gold trade right now.
Yeah.
But I think the irrationality, if that is it is stronger for gold than it is for silver, right? That's my guess there.
If you're on the debasement trade area, physical bullion has a little bit more appeal than owning an ETF that's on
Sure.
GLD or something like that.
Yeah.
So you used to have the magic kind of range for stocks, 30 to 70 bucks.
Price per share, you mean?
Right?
Okay.
So could you use that same theory now for gold, that gold has moved out of that range where it's attainable person to add gold to the portfolio, and then that leads to silver being purchased almost like a commodities stock split?
No, I see your point. Right? There was always this notion that when a stock traded out of that range, we would
then
split it.
because you had to buy shares in 100 and a lot of them.
Yeah,
haven't,
lots, right?
So,
No, but no more. But I
Yeah.
see what your point is. I see. So
gold's
but
getting too expensive. You can't go. It's not as easy to go buy a small piece of gold because now you're talking about a significant amount of money.
that's absolutely.
So,
that's
but if you're
absolutely
still
true.
worried about that, maybe you go pick up some bars of silver because that's a lot easier for you to attain. And that would be equivalent to a stock split that's normally followed by an increase in stock price.
No, I mean, I see your point. I would say that
To hedge that, I have not thought very much about
No,
that.
no,
but
no,
I've
that's
been
a-
thinking
that's a-
about this,
that's quite the
why we
hedge. I'm
haven't
not
had
sure
that,
I'm not.
that
I think I would buy an equity
before you went and tried to buy silver to back gold.
Yes, that's. I mean, because I think what we tell, when somebody asks me, they say, "Hey, I'm really worried about inflation.
Yeah.
What do I do about it?" My response to that is, well, you shouldn't hold bonds. You should hold equities, because you and I think both believe that the return to holding an equity is basically whatever inflation is plus a little bit more plus a risk spread. And even if you hold the risk spread constant as the rate goes up, in the short run, right, you take a beat down a little bit, right? But over the long run, we would believe that the expected returns from the equity portfolio would adjust to reflect
Inflation has to
that
get
new
high
reality.
enough to actually
Right.
crash the economy
That's
before
right.
equities would fall.
And even then,
And-
right, I don't even know what that means. I mean, everybody, learns economics the first time. They learn that inflation in and of itself is not bad, right?
Yeah,
Right. Because it just means if you could
You subtract it from the nominal.
right, almost in almost any class, if you could pricelessly change prices, right? In other words, if it was just like something that every day you got up and here's the price and it didn't do anything, we wouldn't say it would trash the economy. However, we both know that investors and market participants don't react necessarily rationally to those price changes.
Irrational market participants.
They're a problem.
Yeah.
They're a problem. They're a problem for me, at least. But, not everybody views the world that way.
Yeah. So looking at the next quarter here, coming up to the end of Q1, biggest issues, biggest things people should be watching. If they're watching the news, things are coming across the TV screen constantly, watching the news feeds on their phone. Anything that sticks out to you, if you see news about this is something to watch. If you see news about this, ignore it.
I think in the short run, things that I'm going to be very interested to see I'm going to be really interested to see who the replacement for Jerome Powell is, right? I think if you see Hassett, if you
Yep.
see the current economic advisor get the nod, that may tell you something about running the economy hot versus Kevin Warsh getting the nod. That might tell you something different about whether we were going to see negative real
Yeah.
rates and you were going to run the economy hot. So I think the first thing I would actually pay attention to is, because we're going to see that, I think, relatively quickly, right?
Yeah, absolutely.
Because Powell's position as Fed chair ends in May, right now. And the other thing I would pay attention to then is when the replacement gets announced, does Powell step down? Because actually, I think his position as a Fed governor is on until 28. Right. I think his
Mhm.
position as Fed governor does not terminate at the same time his position as chair does. And so I think that is going to be a revelatory, right? So I
And the
think that,
market would move on the
and the
announcement.
market's going to move on that information. Absolutely.
Yeah, it's not going to be May.
And I know this is a little bit of a segue, but one of the things I think that's fascinating that we're starting to see now is you're starting to see the prediction markets move as a
Yep.
result of this. I think you had one favorite up until a few days ago, and then now that's changing. So in terms of the Fed, I really do think we should pay really close attention to who gets nominated, because I think there is information
Absolutely.
in
Yeah.
who gets nominated. And I also think the Supreme Court case on tariffs is going to be important. These are all about inflation.
Yep.
So I think the first quarter of this year, and in fact, we may get apparently news on the tariffs as early as tomorrow, right? I think I'm going to pay attention to anything that really reflects what I think might happen to inflation, the Fed's willingness to cut rates, and the like. Because I'm telling you, if the market starts to believe the probability of rate cuts is falling, then I think that will be bad for equities in the
Yep.
short run, right? So I think those are the things I think we should really pay attention to in the short run, because we're going to
Yep.
get a lot of information.
What would be interesting about that is that could be good for interest rates for bonds
Oh yeah, absolutely.
with having the certainty there.
Having the certainty there, right?
Yep.
I think certainty in this case would be really, really good for knowing that the Fed really is going to try to move back to this 2% target.
Yep.
Or are they going to accept 3%? And
Yep.
I don't know that I know what that is, but I think I'll get information on
But
that.
that's the stuff to watch for.
And that's, I think, the stuff to watch.
Gotcha. Perfect. Well, thank you very much. That's our show. Thanks for listening. We'll see you next week.
The information provided in this podcast is for general informational and educational purposes only and is not intended to constitute financial, investment, or other professional advice. The opinions expressed are those of the hosts and guests and do not necessarily reflect the views of any affiliated organizations. Investing in financial markets involves risk, including the potential loss of principal. Past performance is not indicative of future results. Before making any investment decisions, you should consult with a qualified financial advisor who can assess your individual financial situation, objectives, and risk tolerance. Thanks for listening.